So to answer that and much more, let's welcome on board Mr. Nikhil Khandelwal, the Chairman and Managing Director of Systematix Group, joining us on the show. Nikhil, hi, good afternoon, and thanks for your time. So much to talk about. First up, give us your sense on how you are reading the market right now. Very clearly, we're still dependent on, or rather, we are seeing a lot of impact from everything that's happening geopolitically, because after Trump has rejected Iran's deal earlier this morning, we've seen that impact play out on the market. How have you been reading the kind of market reaction to geopolitical developments, and what do you think lies ahead in terms of how much of our own domestic moves could be reliant on what is happening overseas?
Hi, good afternoon. Nice to be on the show. Well, at Systematix, we have been maintaining the view that the market will be driven largely by what's happening on the crude oil front, as well as the USD-INR front. We are an economy which is heavily dependent on oil imports, and elevated oil prices actually impacts our economic activity in a significant way. On top of it, because of the entire West Asia crisis, we have been having a lot of supply chain issues as well, which are further impacting our factory production related data as well. And that also is leading to a lot of disruption in the supply chain for some very critical industries. So combination of that, I think the normalcy in oil price and hence an impact and a normalcy on the USD-INR fluctuation is going to be critical for us to have a very clear direction of the market. And that's why we have been very clear that as far as market capital allocation for investors is concerned, everybody has to park a large part of their capital in this environment in more safer and more resilient sectors. And if you have $100 to deploy, the capital has to be deployed in a staggered way rather than going all in at this point of time in the market. Because in the next 3 to 6 months, we will see a significant clarity emerging on the impact of the oil and the supply chain disruption on the Indian market. And till the time that data is not clear on the earnings of the company, on the volume growth of the company, etc., we should not go all in as far as market investment is concerned.
Okay. Nikhil, hi, this is Hersh joining in as well. Nikhil, so therefore, what are those sectors? What's your sectoral tilt? You said that you would like to play it through specific sectors, the current market. How would you?
Yeah, no, definitely. We have seen that across sectors there has been significant improvement in value over the last 30 to 45 days. April and May have been quite good overall from a broader market perspective. A lot of the sectors we like and pockets we like have I can elaborate a little bit on that. So within the banking sector, for example, while the banking sector as a whole is positive view for Systematix, but within that PSU banks, we feel that holds a greater amount of clarity in terms of earnings growth, margin, the lack of margin compression, and also in terms of the valuation benefit which we see. So if we have to pick winners within the banking sector, we are more overweight at this point of time given the market situation on the PSUs than the private sector banks. In the broader market also, while a lot of extreme views are there on the IT sector, we remain quite positive on the IT sector as a whole, given the potential for dividends, the potential for significant buybacks, and deep value sitting in some of the large mid-cap and the large-cap IT companies. So we have largely a positive view on IT sector as well, given where the markets are and the need to invest in more resilient sectors. We also believe that in such market conditions, as Indians, I think we need to have a significant weightage on defense and cap goods as a space as well. So any of the larger companies, whether it's the BHEL or the BELs, to larger cap goods companies like the Hitachis and Siemens. We should we should be using this market to accumulate some of these large cap goods as well as defense companies as well.
Okay, so it's PSU banks, IT, capital goods, and defense that you're liking at this point. Nikhil, anything that you would avoid in a market like this, even though we've seen markets come down, maybe you've seen some valuation correction somewhere, and despite that, you'd be avoiding this sector. What would that sector be?
As I said, the private banks as a space, except for the top two, three banks, we will not get into a significant overweight on, the second tier private banks at this point of time. We believe that valuation in most of the second level tier private banks is well priced in. We also believe that any of the rate sensitive sectors, especially real estate, we believe that while the stocks corrected sharply in Feb and March, and a little bit of run up has happened in April, we believe that value in that segment also is well priced. Similarly, in other sectors like highly discretionary consumer businesses like jewelry as a space, unfortunately, that sector has been in a lot of news because of PM Modi announcing the gold purchase to be reduced. But we in general have been quite soft on the entire jewelry as a space, considering it requires significant discretionary spend, and also airlines as a space. So I think these four sectors or businesses for us are fairly valued and something which we should not be going significantly overweight at this point of time.
Nikhil, driving the bullish thesis on IT, give us a sense of that, because that's a bit of a contra call in the sense that don't you believe that AI will impact IT significantly, or do you believe that valuations risk reward is still in favor?
No, I think AI disruption on the IT sector is for real. We are also a firm believer of that. We also are watching and talking and interacting with not just the IT companies, but a lot of companies in the value chain, including a lot of customers of these IT companies. And we understand that the Indian companies are slowly and steadily aligning with the emerging technological shift in the larger AI-led world. The companies are not seeing their order book diminish or deplete at such a pace as the market is making it out to be. In fact, companies are acquiring and building capabilities to deliver AI transition for enterprises. And a lot of the mid-cap IT companies, large-cap IT companies, from Coforge to our systems to even the larger players like TCS and Wipro, have been announcing a lot of investments in that area. And a combination of that, we believe that while this sector will see slower growth in this year, but a lot of it is not going to be a degrowth year for the sector. And the value correction which has happened in the sector provides an opportunity to invest in some of the finest cash flow and cash rich businesses at low teen multiples, which is definitely something which is not to be missed when you look at the long term potential of some of the IT services companies in India.
Okay, point taken. On that note, thanks so much for your time, and good to be speaking with you today. Thank you so much.